I think that in terms of will gold go to 3,000, my response to that is it's not if, but when. I'm certain that gold will go there, and I think relatively soon. I think what the intraday price structure tells us more than anything else is, and today is a great example, we saw gold prices dip in response to testimony by Chairman Powell, but traders quickly stepped in. They bought the dip. They're hungry to get involved in gold, to be active in this market. This is truly a historical time. And what that intraday data tells me, at least, is there are traders waiting for that dip so they can buy it and take advantage of it, because we saw how quickly gold rebounded. And that's happened on other days where we'd see it trade lower overnight. When it got to New York, they would quickly make up that difference and bid it back to positive ground. What's interesting is you can see for the last 7 consecutive weeks, of course, this week is new. We'll have to see if it finishes strong on this week, but we've really seen the market move up. And in terms of the rally itself, this rally has witnessed gold gain from the middle of December to the high that came in this week of about $370. That's a 14% rise. That is strong. Now, this is what I said is standard candlestick chart. If I convert it to what's called a Heikin-Ashi, and a Heikin-Ashi just draws the candles a little bit different. What we look for in this, the difference between these two types of charts is how the open is fixed. On a standard bar or candlestick chart, the open is fixed on the true opening bid, opening price. On this type of chart, the open is fixed from the midpoint of the prior candle. So on a weekly chart, this open represents the midpoint of the previous week. What that does is really smooth this out so that you don't get the scenario where you see red and green candles, but you'll get solid green or solid red. And so we'll go ahead and convert it back into a standard candlestick chart. And what's interesting is that right now, what we're witnessing is where these two charts are showing solid green. This has been a strong rally. This is a new leg, and it followed the correction that we saw with gold trading down, just breaking below 2,600 for a brief moment, and then trading sideways, moving back up. Yeah, this is very strong. I've converted our chart back to a daily chart, and this is what you're talking about right here. Now, it came in, and gold made the highest high on record, right around $30 shy of that elusive $3,000. And that's a key benchmark. Any of those big numbers, 1,000, 2,000, 3,000, are going to be key psychological levels. The interesting thing is when we look at gold, and I'll compress this chart, ever since we hit the all-time record high back on October the 30th, we traded lower and sideways for a while, but once we broke above that, and that is this key point right around here, you can see gold really took off with a fever. And so now we are definitely in uncharted territory. Gold has never had this high of a value in terms of a troy ounce, and we are in striking distance of 3,000. It came very, very close on an intraday basis this week. I think that in terms of will gold go to 3,000, my response to that is it's not if, but when. I'm certain that gold will go there, and I think relatively soon, because gold is still reacting to the key fundamental elements that have been the recent drivers, and that's really tariffs by the new administration. Because in my opinion, we will see some sort of a pullback or correction. We typically do. However, we haven't. And if you look at this entire run from the middle of December up till now, there's really only been brief periods of about a day back on Friday, January 10th, That was followed on Monday by a lower day. That's this red candle here. Here you have almost an inside day. Here you have a day in which it sold off for 1 day and returned, 1 day and returned, 1 day and returned. In other words, with the exception of right at the beginning of this rally, we have never had 2 consecutive days of lower pricing in gold. So the fact that we have a lower price today is not enough information to say that, yes, this is the beginning of a correction. We would have to see follow through, and even 2 days wouldn't give us enough information because we've seen that before, and then it went right back, it kicked right back into bullish momentum. Mm-hmm. And that's why I like to view these candles through Heikin-Ashi, because this is the best way to see strength of trend. And what we look for is body size and the absence of lower wicks. The reason we look at whether or not these candles have a lower wick is what it is saying is when there is no lower wicks, it says that at no time during the trading session did prices go at or below the midpoint of the prior candle. And that's a strong statement when we look right around January 30th, the end of January. The candle sizes really boost up. And when we think about it, that's 10 days after the inauguration. So we saw gold kind of get very quiet just following the inauguration. And then as the executive orders began to fly, market participants reacted with their confident vote against a safe haven asset, which is gold. And that's exactly what we saw. Momentum is still there. This will lag behind real-time data, so it won't be until we actually see some kind of the beginning of a pullback that we'll see that referenced in the charts. But nonetheless, this trend definitely appears to have some real steam left to it and some real momentum as seen through the eyes of this chart type, the Heikin-Ashi. I think it reinforces the long-term bullish case, but realize where the Federal Reserve is concerned, it's data dependent. So we have the CPI coming out later this week. Mm-hmm. We have the producer price index, the PPI, coming out later this week. And what market participants are going to focus on is whether or not they're seeing any uptick in inflation, because the greatest fear from levying tariffs, which are just starting to hit, there's a lag between when they're implemented and when we as consumers see differences in the price we're paying for goods, but whether or not that translates to inflation moving higher. Because if that happens, the Fed's going to have a patience, but they're also going to have to be ready to react to any real upticks in inflation. And since tariffs really evoke the possibility of inflation heating back up, that's what everybody is going to be waiting for. And that's what could change the narrative from what we're looking at now. Well, the first thing is that I've got to say is that when we are in uncharted territory, which we absolutely are, as a market technician, you've basically pulled one of my best tools out of my toolbox, which is to look at how a stock or commodity, in this case gold, reacted at that price point. And once it went above 2,800, which is this top right here, well, we have no historical data to really reference that to. So what I've done on this chart is I've looked at key rallies that occurred. This one at the end of November of 2023. This one is what I'm calling the February to April rally. This is the largest rally last year, $451, a total gain of 22%. The next one is through August and September. That's a 16% rise, or $375. So when we compare these rallies to this current rally that's already moved about $370, if it equals the largest rally last year. It's got another 150 to go. I think 3,000, as I said, is not if, but when. I think that would be a logical point if we haven't seen gold have any sort of pullback or correction. That might be a logical point to look at, because typically when they go and make new all-time record highs in one of 3,000, which is going to carry some weight, it does give shorter-term traders the motivation to pull profits and bank those profits.
Yeah.
However, we haven't seen that. This is the whole thing. When we look at the trajectory of gold, the one thing that we can say is that this recent rise, and it depends on how you compress the chart, but if you look at the tact or the angle on this, it's almost a straight 45%. I mean, it's almost parabolic. And so parabolic up always gives the potential for a hard correction, but we haven't seen it. And the reason this time is different from other times where we would typically see a pullback much sooner is that the fundamentals driving this are strong, because we have a new administration, which has created a tremendous amount of uncertainty. We're getting some clarity as he's passed these executive orders and we see what he's focusing on. But the whole idea in terms of what he's doing with tariffs is genuinely troublesome or worrisome, because it could lead to a global trade war. It's certainly going to lead to higher prices, not just for those in North America and Canada and the United States, but globally, because tariffs are being reciprocated. And that's what he spoke about. He wants reciprocal tariffs, which means that citizens around the world can look forward to higher pricing in the goods that they need every day. And it's not just going to be confined to just North America or Europe or Canada or Mexico or China, but all citizens. And that to me is worrisome. But It's all about if it leads to inflation.